go ahead and get started, and hopefully we can go through it relatively quickly, but I'm going to give an overview of property tax in Georgia. And I forget, is Daugherty, Albany a consolidated government? No, it's Columbus, Muskogee? Columbus, Muskogee is, okay. And how many cities in here levy a ad valorem tax? Majority? Are any of y'all tax collectors, actually collect the property tax? Okay. If you have any questions as we go through this, especially the collection portion, please raise your hand, okay? But property tax in Georgia, the Department of Revenue's role in property tax administration is to principally train local tax officials. And that's a big umbrella. You remember the PowerPoint that Ellen pulled up, this various local tax officials that are elected and appointed, and some are just county employees. That's the bulk of what we do. Also, the Department of Revenue values all public utility property for ad valorem tax purposes. Those assessments are sent to the county, and the county tax commissioner or city tax collector collects those property tax bills. And also, the Department of Revenue approves all county digests. And the county digest has to be approved by the Department of Revenue before the digest can be used for the collection of taxes. And the submitted digest is eventually transmitted to the Department of Audits so they can do their sales ratio studies and perform the tests that they do. And also, the Department of Revenue Local Government Services Division, our division, we make disbursements of funds that's based on the tax digest. So any local funds, some of which are computed based on the tax digest, we disperse out to the cities and counties. So ad valorem tax is administered at the county level. The County Board of Tax Assessors value the property, and they're charged with the duty of making sure all property that's subject to taxation is returned for taxation. The Board of Tax Assessors also approve and deny exemptions, so whether or not a property is subject to ad valorem tax or property tax, the Board of Tax Assessors make that determination. And also, any taxpayer appeals, the Board of Tax Assessors are charged with resolving appeals. So the County Board of Tax Assessors, they're appointed by the county governing authority or the county commissioners. The county tax commissioner. In Georgia, that's an elected position. I know in Daugherty County it's not, but in the rest of the counties in Georgia, other 158, I'm relatively certain it's an elected position. And the county tax commissioner just bills and collects ad valorem tax. The county tax commissioner cannot value property. There's a narrow exception with TAVT appeals on used motor vehicles. But as regards ad valorem tax digest, the county tax commissioner cannot value property or settle property tax appeals. As tax receivers, the county tax commissioners submit the annual tax digest to the Department of Revenue that's constructed by the Board of Assessors. And the county tax commissioner also serves as an agent of the revenue commissioner by accepting the annual registration fee and also accepting title applications on motor vehicles. The ad valorem tax digest is a listing of all the taxable property in the county or city. Each jurisdiction or levying authority in every tax district in each county has a consolidation sheet. And the consolidation sheet lays out the values of all the property subject to ad valorem tax in the county. And the values are at the 40% assessment level. Properties valued for ad valorem tax purposes at 100% of its fair market value as of January 1st, but taxes or the millage rate is based on a 40% assessed value. The assessed value is defined as 40% of fair market value. And this is a summary portion of a consolidation sheet. Property is stratified by property type, and every consolidation sheet will have a summary section with the property stratified as indicated on the slide. So if you want to determine the property tax base in your county by property type, the consolidation sheet's the place to go. The classifications we have, we can go down the list: residential, residential transitional, historic, agricultural, preferential, conservation use, brownfield, forest land, environmentally sensitive, commercial, industrial, utility, and then the special classes of property, which are in value a lot less than the real and personal property that's subject to ad valorem tax. So as you can see, this is a typical distribution. The bulk of the property that's subject to ad valorem tax in any tax jurisdiction is going to be residential, commercial, and industrial. So this consolidation sheet summary is a pretty good average of what you're going to see. The special classes of property: motor vehicle, mobile homes, timber, and heavy duty equipment. Taxes are collected on those in a different manner than real and personal property taxes. If you remember, motor vehicle ad valorem taxes are collected when you renew your tag every year. However, a relatively new tax, TAVT, replaces the ad valorem tax on motor vehicles. So once TAVT is paid on a motor vehicle, that motor vehicle is no longer subject to ad valorem tax, and it's not going to be on the ad valorem tax digest. Another special class of property is mobile homes. Taxes are due on mobile homes beginning in 2016, April 1st of each year. Previous to 2016, the due date for property taxes on mobile homes was May 1st. And timber is taxable when it's harvested or cut. And harvesters and purchasers of timber owe a timber tax, which is equal to the fair market value of the timber at 100%. Timber is taxed when it's cut or harvested, and it's not taxed at the 40% assessment level that other property is. In heavy duty equipment, that's taxable to a consumer end user in the year of purchase on a prorated basis. Subsequent to the year of purchase, it's on the real and personal digest that a tax bill is sent out for in the fall when the county tax digest is approved. And as we mentioned, the Department of Revenue has to approve any county tax digest before it can be used for the collection of taxes. The due date for the submission of the tax digest via statute at 48.5.205 is August 1st. Although this past legislative session, that due date was changed to September 1st, effective for the 2016 tax year. And again, no tax digest can be used for the collection of taxes, municipal taxes or county taxes, until the Department of Revenue issues a collection order on the tax digest. And the millage rate is set by the governing authorities of the tax jurisdiction. So whoever establishes the annual budget, that authority sets the millage rates and adopts the millage rates. And any levying authority in Georgia that adopts a millage rate has to advertise the proposed millage rate and hold public hearings if a tax increase is deemed to have occurred. And we'll talk about what a tax increase is. It's not just a comparison of the previous year mill rate with the current year mill rate. It's a little bit more complicated than that. But in a general sense, to determine the millage rate that needs to be adopted, you have to start out with the budget or the amount of revenue that needs to be raised from property tax, and take that number and divide it by the net assessed value or the taxable value on the digest. So if you have a budget or $3 million that you need in ad valorem tax, and your consolidation sheets indicate net assessed value of $500 million, a millage rate of 6 will need to be adopted to collect the $3 million. That's the fractional formula you use to come up with a millage rate. Does everybody see that in a general sense? I'm sure you probably... Georgia statute also requires any levying authority that adopts a millage rate to roll back the millage rate for the local option sales tax that was collected in the previous calendar year. The sales tax rollback is computed as indicated. It's the sales tax receipts, local option sales tax receipts in the previous calendar year divided by the net assessed value. That will produce the millage equivalent of the local option sales tax receipts. So if a city has $10 million in local option sales tax receipts in the previous calendar year and net assessed value in the current digest year of $500 million, the sales tax rollback would be 2 mills. And that formula is how the sales tax rollback is determined. And the millage rate just has to be rolled back for local option sales tax, none of the other local sales taxes. And the amount of the local option sales tax, as Jonathan indicated, you can find on our website, the Georgia Tax Center. Once you get to this page, you can select the link on the bottom, I think the business link, and that will give you a drop down for sales tax distribution. And the next screen is pretty much menu driven. You just enter your tax jurisdiction and the time period you want the local option sales tax distributions for. And one of the most important things in adopting a current year millage rate is determining whether or not a tax increase is going to occur. And in order to determine whether or not you're going to have a tax increase, you have to compute a millage rate rollback. And we're going to talk a little bit more about that in subsequent screens. But also, because the forest land grant reimbursement that we'll mention is based on the millage rate, that's included in in our advertisements that are required to be done to adopt a millage rate. We'll talk about this, but if you have forest land conservation use property in your county or in your city, in this instance, the state will reimburse the city grant funds equal to 50 cents on the dollar of the digest loss up to a 3% digest loss. For digest loss greater than 3%, the state reimburses the loss on a dollar for dollar basis. And this is the worksheet we use to gauge the digest loss because of forest land conservation use covenants in your jurisdiction. Okay, we'll start to talk about the millage rate rollback. The Taxpayer Bill of Rights in 1999 required levying authorities to roll back the prior year millage rate for an amount of the reassessment of existing real property in the county. And if that rollback rate, which was a prior year millage rate, adjusted for the millage rate equivalent of the reassessment of existing real property in your county or city, if that rollback rate was greater than the current year millage rate, then no tax increase is deemed to have occurred. But if the current year millage rate is greater than the rollback rate, then a tax increase is deemed to have occurred. And we'll be more explicit with that. Try to explain. So principally, we use this worksheet PT 32.1 to determine whether or not a tax increase has occurred. And what we do, we determine the prior year millage rate, and then we get from the County Board of Tax Assessors the reassessment of existing real property in your tax jurisdiction. And once we have that, we convert that reassessment of existing real property value to a millage rate equivalent. And if it's positive, the prior year millage rate is going to be reduced to come up with the rollback rate. So that means if the current year millage rate is greater than the rollback rate, you're going to have a tax increase. Up until the last year or so ago, when the economy was such that property tax values were going down, the reassessment of existing real property number was negative. And in that instance, the rollback rate would be greater than the prior year millage rate. So some counties could increase the millage rate from the prior year, but not increase it up to the rollback rate. And in that instance, no tax increase would deem to have occurred, because the current year millage rate, although greater than the previous year millage rate, would still be less than the rollback rate. Does everybody see that? I know it's a lot to try to understand, but it's important to remember if the current year millage rate exceeds the rollback rate, a tax increase is deemed to have occurred, and 3 public hearings have to be advertised and conducted prior to the adoption of the current year millage rate. And regardless of whether or not there's a tax increase or not, a current digest and 5-year history advertisement has to be done, whether or not there's a tax increase. But if there is a tax increase, as we define it, the current year millage rate greater than the rollback rate, then we have to do those 3 advertisements and hold the 3 public hearings. And also, if there's a tax increase, a press release has to be submitted to the local media. Here's an example of a current and 5-year history digest advertisement. You may have recognized this from the newspaper. You may not, but every county publishes in a newspaper of general circulation this current and 5-year history advertisement every year prior to the adoption of the current year millage rate, whether or not there's a tax increase. And all municipalities that levy a millage rate are also required to do this advertisement. Historically, this 5-year history has had to have been in a newspaper of general circulation in the county at least 14 days prior to the date advertised in the advertisement to adopt the millage rate. But a legislative change this past session reduced the 14 days to 1 week. And it also required for the current 5-year history advertisement to be posted on the levying authority's website. So this has to be done for any jurisdiction that levies a millage rate. Well, let me back up. Special district levies do not have to be advertised for the current 5-year history. Usually most counties just do the M&O millage rate, which is all that we, by policy, require the counties to do and the cities to do. Okay? And if there is a tax increase, remember, as we define that, the current year millage rate, I know I've said it about 400 times, current year millage rate greater than the rollback rate, then we have to advertise the 3 public hearings. And the advertisement has to be exactly as worded by statute. And the advertisement is on the PowerPoint the way the statute dictates that it be worded. And this notice of tax increase has to be at least 30 square inches, and it has to be in a newspaper at least 7 days prior to the date of the public hearing being advertised. We put out a digest advertisement manual that's real good to have when you adopt your millage rate, when you go through this process, because there's a lot of small rules that you have to adhere to by the letter of the law. And because we approve county tax digests, we hold them to the letter of the law. These 3 public hearings, 2 can be on the same day, but if there are 2 on the same day, one has to be before noon. One of the 3 public hearings has to be between 6 and 7 p.m. on a weekday, and 2 of the public hearings have to be 5 business days apart. And also, this notice of tax increase advertisement has to be posted on the website of the levying authority. Now, one thing I haven't mentioned, but I'm going to mention, just M&O millage rates are required to be rolled back. And not special district or bond millage rates. So for advertisement purposes and the determination of whether there's a tax increase, the statute just requires the rollback rate be computed for M&O millage rates. And if there is a tax increase, the press release has to be provided to the local media. The local media is not required to publish it, but the levying authority does have to provide it to the local media. But if there is a tax increase, the 3 public hearings can be held over 2 weeks, because 2 of the hearings can be held on the same day. And this is the timeline we have for adopting the millage rate. The only thing that's outdated on this now is that, remember, the current 5-year history advertisement that you have to do, whether or not there's a tax increase, just has to be in the newspaper 1 week prior to the date advertised in the advertisement to set the millage rate, and not 2 weeks. And once the millage rate is adopted, we need a PT 38. And the PT 38 is just the mill rate certification to the Department of Revenue, to your clerk of Superior Court, and to your county tax commissioner. And the local option sales tax rollback has to be shown, and we have a column for that to be shown on the PT 38. Please try to get these to us as soon as the millage rate is adopted, because we need this millage rate to put in our system, because the amount of AVT funds that you get, alternative ad valorem tax funds that you get, is somewhat based on your current year millage rate. Yes?
Is it okay to, I mean, the counties use, they send it forward to the city?
Yes, that's fine. That's no problem. Yeah. If the city millage rate has been set at the time the digest is submitted, we ask the tax commissioners to include the PT 38s. Okay. But you need to be sure it gets to the clerk of Superior Court also, because you want to get your share of real estate transfer and recording intangible taxes. So always send it to the clerk of Superior Court too. No, that's important to do. Okay. And we talk about forced land conservation use. If you have any of that property in your city, this is a grant request that the funds are requested on. And it's basically the reimbursement value multiplied by the current year millage rate. You can look on your consolidation sheet, and if you have a code F, J, or SJ, you have forest land conservation use property. If you do, you can call the Revenue Department and we'll help submit this grant request, okay? Most forest land conservation use property, since it's timberland, is going to be in the unincorporated portion of the county, but nonetheless, some forest land conservation use property is in city limits. Property tax billing. Taxpayers have to be given 60 days to pay a property tax bill. So when the digest is approved and the county taxes and even city tax bills are sent out, taxpayers have to be given 60 days to pay the tax bill before interest can be added to the account. One unique aspect of property tax billing is properties under appeal. Taxpayers with properties under appeal can receive a temporary tax bill. Counties are required to do temporary tax bills for properties under appeal. Do all the cities here send out temporary tax bills for properties under appeal? Or does the county tax office send you the values for property under appeal before the appeal is settled? Some do, some don't. There's a change this past session in House Bill 202 that provided tax commissioners can bill taxpayers electronically. So subject to tax commissioner approval, taxpayers can receive their tax bill in PDF format. Now we'll skim the top of this because we could spend at least an hour talking about the nuances of temporary tax billing for properties under appeal. Here's the grid we come up with. Up until 2014, it was relatively simple. Properties under appeal, the tax bill would be sent out at 85% of the current year value. But in 2014, it got a lot more complicated and a lot more different options depending on the value of the property and whether or not the property is homesteaded, whether or not there's an improvement on the property. But generally, effective in 2014, if a taxpayer has his property under appeal, the Board of Tax Assessors is required to specify, in general, the lesser of the most recent year that's not under appeal or the 85% value. And that's the basis of the temporary tax bill for properties under appeal. There's exceptions to that that's indicated in this grid. Homesteaded property with improvements in the current year, they have to get a property tax bill at 85% of the current year value. And even property with a fair market value greater than $2 million, they have a unique billing option also. Part of their 85% bill that the taxpayer's request can be put into an escrow account. And here, again, I'm going to be hesitant to talk about all this, but if you do temporary tax billing, the real general rule is the tax bill should technically be based on the lesser of the prior year not under appeal, most recent year not under appeal, or 85% of the current year value. The exceptions to that are in the grid. But we get, going back to this, we get a lot of questions about temporary tax bills, so always call us if a taxpayer has a question at all about temporary billing. We talk to attorneys a lot about this, and okay, House Bill 202 provided that within 10 days of the final determination of value of a property tax, on a property tax appeal, that the Board of Tax Assessors are required to send that final determination of value to the tax commissioner. That's just something that became explicit, I think, in 485311. When the Board of Tax Assessors settle an appeal, or the Board of Equalization settles an appeal, well, let me back up. When the Board of Tax Assessors settles an appeal, they have 10 days to send the final value to the tax commissioner for billing. If the Board of Equalization renders a decision on the appeal, taxpayer has 30 days to appeal to Superior Court. If at the end of 30 days there's no appeal to Superior Court, then the 10 days begins to run from that 30th day. Okay, final tax bills. If upon resolution of the appeal, the taxpayer is due a refund, then the refund is computed based to the following limitations. For the period under appeal, if the property is homestead property, the maximum interest that can be refunded is $150. If the property is non-homestead, the maximum amount of interest that can be refunded for the time period the property was under appeal is $5,000. But how the interest is figured, you take the tax you're refunding and refund it from the later of the date paid or the due date to the current. And if it's homestead property, the interest can be no greater than $150. If it's non-homestead property, interest can be no greater than $5,000. Now this refund is figured at 1% a month. And another change, that's a good change, brought out in House Bill 202 is if at the conclusion of an appeal a taxpayer owes additional tax money, the taxpayer is given 60 days to pay the final tax bill before any interest can be added to the account. If the taxpayer doesn't pay within 60 days of the date of the postmark of the final tax bill, then interest is added from the original billing due date or the original tax digest due date. So that's simple enough, straightforward. Any questions on digest submission? The big thing to remember, most important, is the procedure for adopting a millage rate. Okay? That's kind of important. Yes.
Is there any buzz out there about the powers that be, reviewing the wording in the advertisements that are required? I've looked at this pretty closely for a couple of municipalities, and it's quite misleading to the individual taxpayer.
It's really misleading because everything, the current year millage rate is compared to the rollback rate and not the prior year millage rate.
Right.
That's exactly right.
You can have a situation where you had a significant amount of your properties in your area, but not all of them reappraised, appreciated in value, causing you to need to advertise that. But if you roll it back, you will actually end up with decreased revenues for the year.
You're correct.
Is anybody looking into updating this and trying to figure out some wording that isn't so misleading?
Right, your tax bill's gonna be the same.
unless your property was appraised and that was appreciated in.
Right.
Is there anything, do you see anything in the horizon, is there what needs to happen for a movement to get going, to address something like that?
Just bring it up. I know this past legislative session in House Bill 202, that 14-day requirement for the current and 5-year history was reduced to 7 days or 1 week. But nothing that I know of as regards the determination of what a tax increase is and how it's advertised. But it is misleading. We do a digest class where we talk about this for about 3 hours. And so in an hour, it's not good. Believe me, we've had discussions, and actually this rollback rate or the reassessment of existing real property, that's kind of a fluid number, because as appeals are settled, that number moves a little bit, not much. And there's really other moving parts to this that make it that much more complicated. But that's just the way the statute reads. And
This is part of the taxpayer bill of rights.
yes, that was enacted in 1999.
Yeah, and so, I mean, this would be up to us individually to talk to our legislators at the local level about, but be largely, your elected officials, moving on. And then getting any traction there may or may not be, hard. Somebody, one legislator may be very interested in making changes where others aren't. But, it would just be different from place to place. But it's something that you need to have a discussion with, city council folks and talk about. But in terms of me hearing anything about changing this area, House Bill 202, it took it, 4 or 5 years to get through the process. They didn't do too much in terms of the notice, because a lot of the legislators like it.
Well, now, for the press release that goes along, we do have more flexibility in the wording there, where we can expound a little bit on what is causing it and what it actually means to the individual taxpayer. Is that correct?
The press release has to have the content indicated that we have. Well, if I can find the slide. Didn't we have a press release in one of these? Huh? Yeah, it's more free, but this notice of tax increase, that has to be verbatim. I mean, the code section 48.532.1, it has this actual wording indicated. Now the statute provides that you can provide an explanation for the tax increase. This is just the minimum that you have to have.
You can provide an explanation on that notice of tax?
Right, yes, that's explicit.
Where do you insert that at?
At the bottom,
Oh.
yes.
Well, that's good news, because I was not aware of that when I tried to explain it. I had to do that in the press release, so I ran the press release next to the notice of tax increase, hoping people would read and vote. But you can't explain it down at the bottom of the notice of tax.
Right, yes, you can. Okay. This code section, just since we're talking about it, was changed in 2010, Ellen. The change was that the advertisement had to be 30 square inches and just M&O mill rates had to be rolled back. But I think it was around the 2010 legislative session. And also that session, I think the change was put in that the reason for the tax increase can be included at the bottom of the advertisement. But that's explicit in this code section. Any other questions? But I know some of you mentioned, do be sure to send that PT 38 to the Clerk of Superior Court. Because if you don't, they won't collect the millage on intangible tax and real estate transfer. Which is not a windfall, but it's revenue. Okay, we'll get to tax collection. House Bill 202 this past session, this code section previously read that it would be a misdemeanor to hinder, obstruct, or hinder any sheriff or any levying officer. What did it say, Ellen? Any levying officer levying a state tax execution. But since the state ad valorem tax is non-existent in 2016, a change had to be made to this code section that would still keep it a misdemeanor for anybody to obstruct or hinder a levying officer. The previous version, if I organize my thoughts, I think said that it would be a misdemeanor to obstruct or hinder any levying officer in the levy of a state tax execution. But since there's no more state taxes on ad valorem tax bills, this was modified to provide that it would be a misdemeanor to hinder any sheriff, ex officio sheriff, tax commissioner, or municipal levy officer in the levy of state, county, or municipal tax executions. So that's where that change came from. Another change in House Bill 202 is under general law, if property tax bills are not paid in full within 90 days of the due date, a 10% penalty is added. And the change under House Bill 202 is that the amount of the penalty is going to be based on the amount of unpaid taxes on the date the penalty is assessed, which is 90 days beyond the due date. Previously, if the tax bill wasn't paid in full on the 90th day past the due date, the penalty would be paid based on the total bill amount, regardless of whether or not part of the tax bill had been paid. This change provides that the penalty is based on just the unpaid tax balance on the date the penalty is assessed, which is 90 days after the due date. You could have special legislation in your city that provides for delinquent tax penalties to be assessed in a different manner. And if you do, your local ordinance or provision in your charter would supersede this general state statute, okay?
You're saying it's one or the other, but not both?
Yes, if your local ordinances have a provision for the delinquent tax penalty, that would override this. But if there's no provision, this code section would be what should be applied. The 10% penalty assessed 90 days after the due date. All right, if a taxpayer pays to fail the taxes when they are due, an execution or FIFA can be issued against the taxpayer. Is everybody familiar with what an execution or FIFA? Okay. The terms are used interchangeably. They mean the same thing. But before a tax FIFA or execution can be issued, the taxpayer has to be given a 30-day notice of intent to FIFA. And this 30-day notice of intent to FIFA is a demand for payment. And this letter has to be sent prior to a FIFA being issued for non-payment of taxes on real property. Taxes due on personal property, this 30-day notice of intent to FIFA is not required, but we do recommend you do it, even on personal property tax bills. Okay? It's a mandatory letter, I will reiterate, before a FIFA can be issued on real property tax bills. And at the end of 30 days, if the tax bill is still not been paid, a FIFA can be issued, but this, it looks like, is just an example of a 30-day notice of intent to FIFA. It just informs the taxpayer of the amount of tax that's delinquent and the amount of tax that is owed, and that a FIFA is going to be issued if the tax is not paid within 30 days. In the tax FIFA or execution, it's just the form or process issued for non-payment of taxes. It represents a liability of the taxpayer and a lien on the property, and it's recorded for public record. It's recorded at the Clerk of Superior Court's office, and it's entered on her general execution docket. This is an example of a tax FIFA. So once this FIFA is issued, it needs to be recorded at the Clerk of Superior Court's office. And the recording constitutes public notice of the FIFA or tax liability. And when you record the FIFA, it's important to add the fee to record the FIFA and to cancel the FIFA to the taxpayer's bill, so you do not forget to do it. Because the fee to record the FIFA and cancel the FIFA needs to be paid by the taxpayer. Okay, the priority of tax liens in Georgia. Liens for taxes are ranked as follows. State tax liens are senior, county tax liens are subordinate to county tax liens, or school tax liens, and subordinate to school tax liens or municipal tax liens. But tax liens are first priority and secured. And the lien for property taxes in Georgia attached January 1st. The lien attaches to the property on January 1st. The January 1st of the current year. Remember, it's the value on January 1st that we're shooting for to base the tax assessment on. That's going to be in the digest that's submitted later in the year to the Revenue Department. So if property sells subsequent to January 1st in the tax year, because the tax lien attaches January 1st, the tax lien's still on that property at the January 1st value, regardless of who owns the property. And this is the code section that delineates the priority of liens for taxes. It's Title 48-2-56. And under this code section, liens for taxes cover all property of the taxpayer. Not just the property that the tax is due on. However, your tax lien is going to be strongest on the property that the taxes are due on. If you levy on property to satisfy the tax debt that's property other than the property taxes are due on, your tax lien is not going to be as strong and probably not going to be superior to the liens on property on the other property. Title 48-256, this is still another provision. The lien for any ad valorem tax shall not be superior to the title and operation of a security deed when the tax represents an assessment upon property of the taxpayer, other than the property specifically covered by the title and operation of the security deed. So that means if a taxpayer doesn't pay tax on his homestead property, his residence, your tax lien is superior to any security deed holder or mortgage holder on that property, okay? However, if the taxpayer has a condominium in Tybee Island or a tractor also, we'll get to that, but the holder of the security deed of the condo in Tybee Island, his interest in the taxpayer's Tybee condominium is going to be superior to your tax lien if your tax lien is on the taxpayer's residence in Albany. Does everybody follow my logic? But that's what this code section's trying to spell out. And as we mentioned, you can levy on any property owned by the taxpayer. Levy on property upon which tax is due is superior to other tax liens. We just talked about if a tax lien or FIFA is not superior to a security deed if a levy on property other than the property, if the levy is on property other than the property upon which the ad valorem tax is due. Something to be aware of is if a creditor has interest in property, the creditor can pay the ad valorem tax due on that specific property, and he can prohibit you from levying on that property to satisfy a tax debt. This is just true only if the taxpayer's interest is in property other than what the delinquent taxes are owed on. Does that make sense? Yay, nay, did I make? So if a taxpayer doesn't pay the tax on his residence, but he's got a big tractor, and the bank has a lien on the tractor, the levying official would have to release the tractor from the tax FIFA if the bank that holds the interest in the tractor pays the ad valorem tax due on the tractor. Then that creditor or bank can prohibit the levying official from levying on the tractor to satisfy taxes due on the homestead. Okay? For that reason, it's always best to levy on the property that taxes are due on to satisfy the tax debt if you can. And for collecting delinquent municipal tax, examine your charter and local ordinances for any procedures or anything unique to your jurisdiction for collecting delinquent tax. Anything that's not covered in your municipal charter or ordinances, state law prevails, okay? And once a FIFA is issued and recorded, the next step in the collection process is to identify some of the taxpayer's property that you can levy on and eventually sell to satisfy the tax debt. And as we talked about, preferably you want to levy on the property that tax is due on, because your tax lien is going to be senior to all other liens on the property. But to do that, there's a process of advertisement and notices to creditors and the owners of the property that has to be done prior to a tax sale taking place. But to back up a little bit, it's always important to issue and record FIFAs, because FIFAs, once they're recorded, they're public notice of the debt. And a lot of times, creditors will not extend a taxpayer any credit if there's liens on any debt, public debt, that's outstanding against a taxpayer. In our practice, if personal property tax bills, those FIFAs are recorded, If it's an expensive piece of equipment, the chances are if the property tax hasn't been paid, they haven't paid the bank either. And if you have a recorded FIFA on a personal property tax bill, when the bank forecloses on their collateral or the tractor, a lot of times they'll send it to an auction, and the auction, if the FIFA is recorded, will send you notice of the auction. An auctioneer will pay any recorded tax FIFA. Usually, it's not uncommon for tax commissioners to collect personal property taxes in that manner. So a recorded FIFA aids tremendously in tax collection, just because it's public notice of a lien on the property. But the process in a nutshell, remember, we have the 30-day notice of intent to issue a FIFA against the taxpayer. If they don't pay within the 30-day notice, the FIFA is issued and recorded. The next step is to levy on the property that you're going to levy on to satisfy the tax debt. And if it's real property, the levy is just an entry on the actual tax FIFA that's recorded. But it's just a writing on the tax FIFA, and you record the entry of levy with the clerk of Superior Court. And then within 5 days of that date, you have to send a notice to the owner and tenant of the levy you've made upon the taxpayer's property and upon the creditor's property. And so once you've done that 20-day notice, then you can advertise the property for tax sale for 4 consecutive weeks. And at the end of advertising the property for 4 consecutive weeks, a tax sale can be conducted on the first Tuesday of the month. But in addition to advertising, the taxpayer has to be given the 10-day notice of the tax sale, as indicated, and that can be done during the 4 weeks that the advertisement's being conducted. And if there is a IRS lien on the property upon which the levy is made, the IRS has to receive a 25-day notice of the tax sale. But that's the process to conduct a tax sale, and you really have to dot your I's and cross your T's. It's very procedural. And there's court cases where tax sales have been thrown out just because a levy wasn't done properly. And all that means is the entry on the FIFA that a levy's been made wasn't indicated on the FIFA. That invalidated the whole tax sale.
Question.
Yeah.
If a tax sale takes place and there is a lien that the city placed on that property, just say like a demolition lien, but when they did the search, they didn't go back far enough and they didn't catch that lien, what happens if that property was sold without selling that debt to that lien placed on the city?
You'd have to rank the lien. And if it's a municipal tax lien, I would get with the tax commissioner as regards excess funds. But really, if there's not a defect in the notice requirements, if it wasn't caught, it's a mistake. And if the city should have received notice, the tax sale's voidable or could be void. You have to look at the unique. That's just something that's part of this process, because it's designed that everybody that has an interest, recorded interest in the property, be notified. But the people that are required to be notified are as follows. And in Georgia, when property sells at a tax sale, real property, a sheriff's deed's issued. And a sheriff's deed transfers title for property tax purposes, but the buyer at a tax sale doesn't have a fee simple title. there's a 1-year redemption period that has to take place before the tax sale purchaser can foreclose the right to redeem. And foreclosing the right to redeem shuts out other creditors that have an interest in the property. So theoretically, if that lien you're talking about is strong enough, a government could purchase the property from the tax sale purchaser to protect their lien. The downside to that is you got to pay the cost to the tax sale purchaser that he paid at a tax sale plus 20%. So unless you have a real strong lien, you don't want to redeem the property. Yes.
IRS also has a right of redemption in those situations and stuff too.
Yes, depending, that's exactly right. Now, the IRS gets a 25-day notice, and that's a notice that's required to be given to the IRS. But once the tax sale takes place, if there's no defect in the tax sale, then basically the tax sale purchaser gets what he paid at a tax sale plus 20% if any creditor wants to redeem the property. But all these patterns, that this is why, like you indicate, if something's not recorded with the clerk of superior court, you're not going to get notice. And theoretically, I'm not an attorney, you could lose rights. The creditor could lose some of his rights.
It was recorded, it just didn't go back into the search part of
That could be a problem. Stuff like that's a problem. And, I don't know that I'm not an attorney, and we'd have to look at the fact pattern of exactly what happened. But the mechanism for that is the 1-year redemption period. If your lien's strong enough, you need to redeem it from the tax sale purchaser, which obviously most are not. If they were, they would pay the taxes before it goes to a tax sale. And by the same token, if you levy on personal property, you issue a bill of sale and there is no 1-year redemption period. So your bill of sale for a personal property tax sale transfers title to the property. But the only caveat with that, if you're selling it just for municipal taxes, you need to be sure that there's no county tax owed on it. Okay? But this tax sale process, it's particular and real detailed. And actually, if a county starts out with 200 delinquent accounts, by the Tuesday of the tax sale, it's down to about, on average, 4 or 5. People come in and pay. So, but it's unique to talk about the different fact patterns and what tax offices run into in delinquent tax collection. It's pretty interesting, and we do a 2.5-day class that we could talk about all sorts of different collection scenarios. But once the tax FIFA has been paid, it's important to cancel the FIFA and record the cancellation at the Clerk of Superior Court's office. The code section indicated requires the entry of satisfaction to be recorded on the execution docket. And the statute records the entry of satisfaction to be recorded as soon as possible. So as soon as the FIFA has been paid, record the cancellation. And as I mentioned, once it's paid, the FIFA, you stamp it paid, and then you just record it from the Clerk of Superior Court. And you mail the canceled FIFA to the taxpayer, is what we recommend tax commissioners do. The big thing is just to get it canceled. and the cancellation recorded. In a nutshell, that's delinquent tax collection. As I mentioned, we kind of really skimmed the top, and we could talk about it really for 2.5 days, easy. So. Any questions?